Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior Podcast. Our goal with this podcast is to sit down with top market practitioners, hear about some of their lessons learned through their careers in the financial industry, understand more about the tools and techniques that they use to evaluate market conditions, and get a sense of their outlook. What opportunities are they seeing and hearing right about now? Today, I'm going to share with you a recent conversation I had with Joanne Bianco. Joanne's had a fantastic career as a fixed income portfolio manager. Just recently joined BondBloxx as their senior investment strategist. They're an ETF issuer with a lot of ETFs specific to the fixed income space: Treasuries, corporate bonds, high yield bonds, even private issuance like CLOs. I'll let her describe some of those different tools, some of those different opportunities, and where they could fit into a portfolio. Had an opportunity to ask Joanne about how she approaches the markets, questions about the macro environment, where opportunities could lie, and then some of the ways investors could think about ETFs, particularly in the bond space, as part of a larger portfolio strategy. Please enjoy this recent conversation with Joanne Bianco of BondBloxx. Super excited to be sitting down today with Joanne Bianco. Joanne's the senior investment strategist at BondBloxx. Joanne, I've followed your work and have really been excited sort of getting ready for the interview, and I'm excited to talk with you today. Thanks for coming on the show.
Thanks very much for having me, David.
I feel like there's a lot to talk about right now. The macro environment seems as challenging as ever, with a lot of moving parts and a lot of question marks for many investors. So I definitely will get through the course of our discussion, I'm sure, to the current market environment, sort of where you're seeing things. Talk to me a little bit. I mean, what's interesting about your role? We were talking before we got started. You have a number of years of experience being a fixed income portfolio manager, really being in a money management role. Now you've switched to BondBloxx, which was really, a bit of a different role, more of a strategist role. Talk to me a little bit about that, your experience, maybe some of your formative experiences as an investor. What was that moment when, as a bond investor, where things started to make sense, I guess, and what drew you to the fixed income space in particular?
Well, it's interesting because, I'm one of those people who actually wanted to be like a credit analyst, security analyst ever since I was in college. So something that, from a very young age, it was a career path that I was drawn to. And at that time, way back in the beginning, the only thing I knew about security analysis was really what equity analysts do. And but it wasn't necessarily an easy area to break into. And so the way that I was kind of able to break into this business overall was by starting in a credit trading program at one of the major banks in New York. And so from there, like, my path just started to go down onto the fixed income side. I started out in middle market lending way back in the day, and then moved to one of the rating agencies, Standard & Poor's, where I had to do very in-depth analysis of individual companies for their ratings, and then finally moved to the actual money management side, and was focused on investment grade and high yield corporate bonds for the majority of my career.
It's interesting, and I spent a number of years at a large investment firm in Boston, and I definitely saw a challenge for a lot of people going from a kind of an analyst role or a ratings agency type of thing, where you're digging very deeply into very specific things, right? An individual line, credit of some sort, versus a portfolio manager role where you actually have to understand the entire forest and not just the veins on an individual leaf on an individual tree. Was that, or can you talk to us a little bit about some of the challenges you faced going from like an analyst looking deep, very detailed, to having to force yourself to be a little broader in your thinking and understanding sort of the relationship between the macro environment and individual bonds you might be looking at?
Yeah, well, I was lucky to have all those formative years as a credit analyst, and also following a lot of different industries. I followed financials, I followed paper and forest products, I followed consumer products. So there was a good cross-section of industries that I followed as an analyst. And then I was lucky enough to be made the director of research, which broadened what I saw more even before I turned into a portfolio manager. So all those things, just being able to, first of all, start out and by doing very in-depth analysis, then moving into a variety of industry coverage, and then finally, being a head of research where I saw a lot of different things. Just all of those things prepared me to become a portfolio manager in credit.
So talk to me about this then. I mean, obviously the macro conditions now, I feel like so many people are just struggling to get their head around everything. We've got the Fed in a rate cut cycle and the next Fed meeting coming up here very soon. We're coming through a period where we've had a bit of a lack of economic data coming out with the government shutdown, which is now kind of restarting. Can you start us off just talking about when you're thinking about different areas of the bond market? Can you talk about the relationship between macro conditions, macroeconomic data you might be following, and how that impacts your ability to understand specific areas of the fixed income market, specific issuances?
Yeah, that's a very good question as well. So I think, yeah, where we start from is we just kind of look at the overall macroeconomic backdrop, and
Yeah.
then how that relates to all the different asset classes. So basically, we've been in a very resilient U.S. economy. Of course, there's pockets of weakness, in terms of some credit weakness in the leveraged loan market, or the labor market being softer for a number of months than expected. But in general, we're just still in a really strong environment for fixed income investments, and especially credit investments like investment grade corporates and high yield corporates, where I've seen so many cycles, having started in this business when I did. And one of the things that I see different now, and it's still continuing, is that in the corporate bond markets, you're not seeing levels of excess developing in terms of a lot of money chasing really speculative ideas, or a lot of M&A. The majority of the bonds that are issued in the corporate bond market have been for refinancing purposes in the high yield market, for example. And so it's basically, you have a high yield market that's on firmer footing than it's been in years. And so when people talk about, credit spreads are tight in comparison to history, well, they're tight for a reason, because we are still in a stronger fundamental place for investment grade and high yield corporates.
You mentioned credit spreads, which is one. I mean, there are areas of the bond markets that I follow very, very closely. Things like interest rates, certainly credit spreads. I look at high yield spreads pretty regularly,
Mhm.
more from a technical perspective more than anything, but really trying to just understand risk appetite and things like that. Can you talk a little bit more about credit spreads and where they're at now, maybe versus your expectations? Has been surprising how narrow they've been. It seems to be showing quite a decent amount of confidence here.
Yeah, it's showing confidence because it should show confidence. There really aren't like the looming, ticking time bombs in the public corporate credit markets. So that's why, you would actually need a real catalyst for them to not only widen, but widen, back to where, what you would see like in a downturn, or an
Sure.
economic downturn, or some kind of some kind of industry sector that the problems are so bad, like you saw like with telecom or with energy, that in the past that they reprice the whole market. And we're just not seeing the conditions for that. We have defaults have been relatively benign in the public high yield market. And, we're expecting, and that's like the third year in a row for that. And we're expecting that to continue even into 2026.
So if things seem pretty decent based on how you summarize, right? Conditions seem okay, spreads are narrow. What does concern you? What's sort of the risks that you see out there? What would be the thing that would start to change these conditions where we would start to see more of a risk off feel from the bond markets?
I think that if we saw a sustained reacceleration in inflation, obviously that would
Mm,
have negative impacts on the bond markets and fixed income securities in terms of price movements. Also, if we did start to see any kind of excess develop in terms of financing in the debt markets, which we're not seeing, and if there's some kind of external shock that none of us are anticipating at this point, that's the nature of that.
I feel like
That's
life in
something to look
2025 has been all about external shocks we're not ready for, right? But I hear you. I hear you. What? So tell me this then. I mean, we're preparing for the last Fed meeting of 2025 here coming up in the month of December. Now everyone's sort of starting to look forward to the beginning of next year. Put on your Professor Joanne cap. How would you grade the Fed's sort of performance in 2025 in terms of their ability to manage their dual mandate and do what needs to be done? And then what are your expectations going forward? How do you think they address conditions going into the beginning of next year? But start with the report card. How do you think it's going?
Well, that's a great question to grade the Fed. I don't know that I actually want to give them an exact grade, but I think there are many things that the Fed's doing well. They're updating their framework. They're mindful of both sides of their dual mandate, of price stability and full employment. They certainly have to adapt to new conditions all the time, like the tariff news, starting with Liberation Day, the government shutdown this fall, having to make decisions without all the economic data that they're used to, and data that still hasn't caught up. But that being said, one of their main objectives to return inflation to the 2% target level, that they haven't achieved that. They have navigated a lot of risks though, and on the positive side, even though the unemployment rate is ticked up, it's still historically at a pretty decent level in the near 4.5% range. So to get the best grade, I would think that the Fed would need to demonstrate clear and sustained progress on inflation, and that doing that with like economic growth holding up and the U.S. labor markets remaining strong enough. And as far as 2026 is concerned, I mean, we're just not of the mindset that the Fed should need to cut rates multiple times next year. I mean, to be honest, don't even know that the interest rate environment hasn't been obviously overly detrimental to the U.S. economy in terms of its growth, in terms of its outlook. So it seems to us it's not necessary to it's not overly restrictive is really the words that I'm trying to find here. And so that being said, do they really need to cut aggressively from here? That's just not our view.
Yeah. That was a very diplomatic answer when I asked you to grade the Fed, Joanne. I'm not surprised, but that was very, very well said. I always tell people that dual mandate that they have to do is not a dual mandate I would wish on my worst enemies, and it's a thankless role I think they have to fill, and almost impossible. So, so that's well said. But I hear you. I mean, the market earlier had been pricing in much more aggressive rate cuts. Now, I mean, it's really kind of stable going into the first, quarter, maybe into the second quarter, maybe getting down to 3% or so eventually. But well said. Do you think that 2% inflation goal, is that a mythical, unreachable goal? Because that's been, I mean, is that just sort of this, maybe it's a not possible, but an opportunity to just set an aggressive objective? I mean, is that something that could possibly happen? Because I feel like if we would have gotten there, we would have gotten there already, right?
Well, we might have gotten there if we didn't have Liberation Day, right?
Right. Yeah, that's fair, right? So that brings me to my next question, Joanne, because you mentioned earlier sort of the one, if there are no big one-off things, here's kind of what happens. I feel like 2025, certainly on the equity side, I mean, it's been all about these one-off shocks, right? Tariffs that end up, taking a form that no one kind of guesses. Obviously, social media becoming a big driver of asset prices all of a sudden. Can you talk a little bit? I mean, through your career, this is a bit of a new world that we're in. in terms of the administration, how, the data that we're getting. How do you manage sort of that that one-off risk, sort of those random things happening versus much more predictable types of risk that you could see, looking at the fixed income markets? Is there a way that you manage risk to try to cushion yourself against big unpredicted moves like we've seen?
Well, then it's hard to actually justify being in the markets when you really manage for, the downside. So,
Yeah.
and then actually, especially in fixed income, the majority of your return year in, year out is from the coupon income. So
Right.
that's the primary determinant of return. So our main message for investors, unless we really thought the US was headed into a significant downturn, is kind of to stay the course and not really overreact to any of this news, and use um, time periods of market weakness to buy on this weakness, and be able to take advantage of some of the opportunities that you see with more volatility.
I feel like that's your years as a portfolio manager probably coming out very well with don't get too overexcited about little
Right.
movements. Try to think bigger picture. If only we all had that patience, I would say, in our processes. So with what you're doing now at BondBloxx, Joanne, it's a series of bond ETFs and fixed income market ETFs that you guys now provide. Can you talk to me a little about, for individual investors, for advisors, how should they be thinking about fixed income exposure? Because I think a lot of people, if anything, they're kind of probably going back to the 60-40 kind of balanced sort of approach if they do think about it. But now going forward, how should investors be thinking about exposure to fixed income?
Yeah, well, what we're finding is that just like in the equity space, investors have really wanted more of the ability to easily trade in fixed income
Mm.
like they've been able to in equities. And so that's where fixed income ETFs have really started to come into play for a lot of investors who really just like the daily liquidity, the transparency, the tax efficiency. They also, I mean, it's just something that, investors are starting to now get a lot more choice in terms of the fixed income ETF exposures that they are available to them. And I mean,
Yeah.
that's precisely why, like, my company was organized over 4 years ago now, but it's to give investors more choice and flexibility. And so with precise exposures in fixed income, like they had always on the other side on equities. And we're in a yield environment where fixed income investments are still attractive, and they don't have the volatility of equity. So you're getting attractive income-based returns with a lot less volatility and providing like portfolio diversification. So there's definitely been a lot of movement towards fixed income. In fact, you've seen this year in particular, there's been record inflows into fixed income ETFs, the largest year ever, over 390 billion
Wow.
into fixed income ETFs this year, and it's across a wide variety of asset classes too. So just it's definitely something that investors are seeing, that they have the ability to invest in fixed income and have choices in fixed income.
Yeah, the ETF sort of structure definitely attractive for a lot of investors. To be sure, it makes it a much more consistent thing. When you're looking at any sort of bond ETF and as part of a larger portfolio approach, is looking at the fixed income markets today just a source of income? Is it a way to manage risk? Is it a mix of both? Like how should we be thinking about, I guess, the role of that sleeve of a larger portfolio?
It is like it is both.
Mm.
You're basically able to definitely the income is something that investors should consider, but there's just a lot of, you can use fixed income strategies for a wide variety of reasons. You can balance safety and yield, and with various approaches to managing interest rate risk or credit risk, and so that's why we think fixed income is definitely present in everybody's minds in terms of another investment alternative.
With for investors that are a little more familiar with the equity side and equity ETFs, I think they probably have a sense, certainly by now, of the different risks that you're exposed to, right? I mean, company risk, earnings risk, obviously macroeconomic risk, volatility risk, earnings risk. The list kind of goes on of different risks. I always think of bond investors as way more attuned to potential risks than equity investors, generally speaking.
Mm-hmm.
And I know from my years at Fidelity, when things would get hairy, going to the fixed income team, going to the high yield team, they would often have a much better sense of risks as opposed to a growth PM who was just thinking of shooting the lights out with the next home run. What are the risks specifically with bond ETFs, right? I mean, so if I buy a bond ETF, what are the risks that could cause the value to change in a way that I wouldn't be happy about? Is it the macro drivers, things like inflation? Is it interest rates having a significant shift? Like, what are the risks, more specific nuance to bond ETFs?
Yeah, well, the thing is that what is nice about fixed income ETFs is that most of the strategies have, or all of the strategies really are very well diversified. So you don't have like that individual security risk in fixed income ETFs like you might have if you're buying individual equities or even individual bonds. But there are definitely risks, that might be misunderstood or not understood by individual investors. And so it's just things like, interest rate risk, for example. The most investors think, oh, bonds are safe, they won't fluctuate in value, but bond prices definitely can be volatile based upon interest rate changes. And it's kind of like the longer you go in maturity or the longer in the duration, the more volatile that you can see. There's also credit risk, which is the risk that the bond issuer won't make their interest payments or repay their principal. But that's something that you just have to determine what your risk tolerance is, and there's just so many different options. I mean, we have options all the way down the credit quality spectrum in corporate bonds, starting our favorite place is in our triple B suite. We have a triple B suite that's broken down by maturity. So like right now, I really like our intermediate triple B corporate products, triple BI. So because I just think, we're still in a good corporate and corporate credit fundamental environment. So you're getting a yield pickup, a coupon advantage that translates into good total return. But we go all the way down the risk spectrum from double Bs all the way down to triple Cs in high yield. And it just depends upon your goals, your risk tolerance, your holding period, all the things that investors know.
So, with when I'm looking at the suite that BondBloxx provides, there's a number of different areas, obviously, that you can get exposure. For someone who's just getting started, for someone who's less familiar with the different ratings and the different opportunities, what can investors do to educate themselves a little better on those different opportunities? And where do you find sort of novice investors should start when looking at the different options in the bond markets?
Yeah, well, I think where they should start is they should. I mean, I guess the first thing, stepping back is investors should understand their own risk tolerance. They understand their situation, their goals, their risk tolerance, to just make sure that anything that they look at aligns with their overall strategy. And then I guess there's just really being exposed to all the financial news, either on networks or in print. Just staying updated on economic indicators, on interest rate trends, on the bond market through financial news outlets. So there's also many organizations that provide and educational platforms that provide courses on bond investing. Speaking to financial advisors is definitely a good idea, especially if they specialize in fixed income. And so, or listen to podcasts like yours.
Hey, Joanne, I hope you would have gotten there. Thank you for finally getting. No, you're good. No, I think that's well said. And honestly, I mean, I think a big focus of what I do is trying to encourage people to educate themselves. And there's so many opportunities now more than ever to learn more about different nuances of these markets. So back in the day, I remember asking one of my coworkers about the bond markets, and he dropped the Frank Fabozzi nightmarish big dead weight book on my desk, which I think maybe it might have turned me off from bonds altogether because it was a meaty read, but it did help me understand things. What is there a book that you would that is a good introduction that off the top of your head? And if not, can you write one?
Actually,
there's
it's been a long time since I've gone to a book for it, but I just feel like in Investopia, there's just a lot of, or just even going into some of the AI platforms and asking questions, you can get some really good information.
Right? So here's a side. We'll digress for a moment, and then we'll wrap things up in a very professional way. Do you use AI and in some way in what you do, and has your use of AI evolved in the last 6-12 months?
Well, the thing is like, for the majority of my career, the big focus for what the firm that I used to work at for, over 30 years was developing independent thought or independent research. So from that perspective, it was just like, my employer and even BondBloxx, they're not looking for me to just parrot something that I see out there. It's really just, what do I think based upon, my knowledge of the situation, all my research and everything like that. But for the most part, if there's some shortcuts I can take in terms of asking a question and just seeing some of the relevant research out there very quickly instead of having to search for something, then that's a great use of AI in fixed income research.
I miss being at a larger firm, Joanne, and having a research assistant, which I could send on tasks like, hey, look into this. So I am using AI for those kind of things. But you're right, AI, and honestly, the answers it provides is only good enough if smart people like Joanne Bianco and others are saying really smart things that it's somehow looking at. So I guess independent thought still matters more than ever, I would argue here. So let's finish here if we could. So, I mean, the interest rate environment in the U.S., getting back to the current markets, I mean, the 10-year yield has been kind of in a slow and steady downtrend, right? After the April equity markets lows, 10-year yield kind of spiked up a bit, but it's been trending downwards, currently just about 4%. What's sort of your expectations for the 10-year yield through year end into the beginning of next year? How does that inform your thinking about the fixed income space and where you might find opportunities in the new year?
Yeah, I guess we think they could continue to trend down, but nothing like they've trended down already. So it's just like, it's been kind of a major move in recent months, and we think it's kind of closer to the end of that move as opposed to like another big leg down. But in general, we just still feel like, the markets are strong enough that it's a great time to continue to focus on credit sectors like public and private investment grade corporates and high yield and emerging markets, tax aware strategies. So just like anything that you can get like spreads above US Treasury rates, we think are a good idea now. And, so we have 27 ETFs across all these different asset classes. So, to provide investors choice to be able to do this.
Okay, I lied. One final question then, Joanne. You'd mentioned some of the different ETF offerings. I think for a lot of people, I mean, the fixed income market's obviously quite large for those that are not familiar, and it's actually quite diverse, right? I mean, a lot of people think of bonds as the 10-year treasury, but obviously there's corporate debt, there's high yield debt, right? A little riskier corporate debt. There's also private issuance of different sorts. I mean, with all the focus of trying to allow individual investors to access private markets, are there ways through bond ETFs to access private issuance as opposed to public debt? And what would that look like?
Yeah, there definitely are. I mean, we launched a fund roughly a year ago. The PCMM is the ticker, and And it's, was one of the first funds to, in a kind of a milestone, to offer access to private credit. And we do that through buying CLO investments, and which have liquidity and trade in active secondary markets. And so our fund is focused on providing exposure to pools of middle market loans. And again, that was where I started in my career. And it's not a new area. Like, people talk about private credit, like, oh, this is all new. Middle market is not new. Like, that's like 1/3 the size. It's a huge part of our economy. So
yeah,
and it continues to do very well fundamentally.
very, very interesting. Joanne, I feel like we just scratched the surface of all these different areas, but this was super helpful. I appreciate you answering some rookie questions about how you're thinking about fixed income, different ways to get exposure. But thanks for sharing some insights with us today. Appreciate it very much.
Thank you. And they were great questions, and I really enjoyed being here. Thank you very much.
It was a fun conversation. Thanks again to Joanne Bianco of BondBloxx for joining me from Chicago today. I'm not kidding. That story about one of my bond colleagues dropping the Frank Fabozzi beast of a textbook on my desk, that is a true story. I remember it vividly. I was looking for it to try to show it to all of you. I can't find it. It's somewhere buried in the cavernous bookcases that I have here with my personal collection of investment books I built up over my career. But I definitely remember reading that years ago. It was a tough read for me, but definitely opened up my eyes to a lot of nuances of the bond markets that I think Joanne beautifully touched on here today. A couple takeaways to think about. Number one, I really appreciate her comments about the current market environment in terms of the economic outlook and the conditions. The fact that, honestly, in her opinion, the Fed may not need to lower rates much more aggressively. I think a lot of people, certainly on the equity side, thinks the Fed lowering rates is what we need. That's what's going to sustain this bull market. But the economy is doing okay. Why would they need to, right? I mean, that should be something reserved for a different part of the cycle. Really appreciated her comments about the Fed, that dual mandate outlook for early 2026. Also, comments about how to think about bonds and bond ETFs. Again, I think a lot of investors are caught in older ways of thinking, the 60-40 kind of balanced portfolio. Now with things like Treasury bonds, corporate bonds, high yield debt, CLOs, those are collateralized loan obligations. The fact that all of those are in ETF wrappers in 2025, allowing you to gain exposure to the fixed income markets without actually buying bonds is pretty powerful. And I think the opportunities for investors have just grown. And I think that's generally a good thing for individual investors and certainly for financial advisors managing others' capital as well. As you notice, we talked a lot about risk, and that is something I have learned consistently from conversations with a lot of fixed income investors over the years. I have found generally equity investors tend to be way more focused on potential rewards than potential risks. We think about buying the next home run, buying the next 10-bagger, finding the next thing that's going to grow earnings and grow and have capital appreciation that drives the stock price higher and higher. I found fixed income investors tend to be way more focused on potential risks because their job is to try to make sure that whoever's issuing that debt is going to be able to meet their debt obligations, right? Going to be able to make those coupon payments that make it a fixed income, that give you those monthly or quarterly payments that are the whole point of owning bonds in the first place. So bond investors tend to be way more focused on potential risk because they want to make sure that their bonds are going to be paid as expected. And so talking to someone like Joanne about risks and where those risks could be, how the markets could shift, and what sort of indicators could help us understand that. Really appreciate her comments about inflation, unemployment, just how that relates to the overall environment for fixed income investors and for the investing public largely. Thanks again to Joanne Bianco joining us from BondBloxx in Chicago and sharing some thoughts with us. As a reminder, any other conversations you'd like me to have, experts in the fixed income, currency, commodity markets, wherever else you want me to go, please drop a comment and let me know. I'm happy to consider future guests and have good conversations with them and ask the questions, hopefully, that are on the top of your mind if you were able to sit down with them yourselves. By the way, if you want to learn more about the tools and techniques that we use in the technical analysis community to better understand trends and momentum and breadth and sentiment shifts, and how risk versus reward can help you make informed decisions in your own portfolio, our Market Misbehavior Premium memberships could be a great opportunity for you to supercharge your investing life here at the end of 2025 and beyond. For more information, go to marketmisbehavior.com/premium. 3 great benefits to the premium membership. First off, you'll be able to take all of our virtual courses like Flight School, Behavioral Investing, where we teach about behavioral finance. That's what's happening between your ears. Technical Analysis, a practical set of tools for you to better understand the world around you as an investor. Second benefit, you will have all of our member reports like our weekly flight plan, our main report that we put out every weekend. What did we learn from the week that just happened? What levels, signals, patterns are we looking for in the week to come? Also our monthly chart review, where we take a big step back from the day-to-day movements, think more longer terms about trends and shifts in those trends. Finally, you would have full and immediate access to our member community, where you can ask questions, you can learn along the way with a lot of other committed, like-minded investors trying to make sense of the markets. I'm in there every morning answering questions, sharing charts, and we'd love to have you join us there as well. You can access all of that by going to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts.